Dividend investors, bonjour. This is Mike Héroux, founder of Dividend Stocks Rocks and passionate investor. I'm here today to help you invest with more conviction so you can enjoy your retirement. This is part 2 of our banking on banks session. So basically, earlier this week, I've done a quick video telling you what's going to happen during the earnings season for banks. And now that the big six have reported their earnings results, let's dig a little bit deeper into each of them. First, I want to tell you, I decided not to talk about Laurentian Bank and Canadian Western Bank. First, they're not part of the big six. And second, let's put it politely, they're not going to increase their dividend and they're going nowhere right now, and I don't like them at all. So basically, instead of like adding more noise to the discussion, just forget about those. If I have to put $2 on a dividend cutter among the banking industry this year, I'm putting my $2 on those two weak horses. So let's focus on the 6 strongest bank, all right? What do we have here? Over the past couple of months, we have seen the entire banking industry lagging behind the market. What you see here is Bank of Montreal at minus 30%, and we're talking total return. So basically, even after receiving your dividend, you still have to be very patient because you're down 30%. Then you have ScotiaBank at minus 21, and among the best performer, we have Royal NTD minus 10, minus 14, still lagging behind the TSX 60, which was at minus 9%. What's happening? Well, obviously, we expected some very bad earnings this quarter, and we got them. On average, if you look at those numbers, the variation for the adjusted earnings per share is minus 50%. The worst one was CIBC at minus 68, and the best one was National Bank at minus 33. Interesting enough, only 3 banks out of 6 beat expectations for both earnings and revenue. We're talking about National Bank, Bank of Nova Scotia. I can't keep saying Nova Scotia, but it's only ScotiaBank. Sorry about that. I just had too many lobsters lately. That's probably what happened. And also CIBC. What I did here is I also put the dividend to show you that Royal Bank, and then we have also CIBC and BMO that all show a payout ratio for this quarter over 100%. So now, should you be worried? Not at all. Actually, all dividend remained the same. There was no cut and there was no dividend increase. However, when you look at the past 12 months and you look at the payout ratio, the highest that you'll find is Royal Bank at 59%. So we will need two more quarters with very high provision for losses to hurt earnings like this and see dividend that could be vulnerable to a dividend cut. Actually, this is what happens here is the provision for credit losses surge everywhere. So we can see variation going from 400 to 500%. The only weird one is ScotiaBank. I'm going to get there to a moment, but just to show you a little bit what happened here, you have total loan portfolio, the current provision for credit loss, which is basically an accounting number. I'm going to get there to a moment, explaining to you exactly what it is. Then you have the difference. So for example, for Royal, we go from $500 million to $2.8 billion. So it's an increase of 464%. I'm pretty sure we never saw that in the market, but yet, the analyst was expecting that, the overall market expecting such bad numbers, and overall good news. Actually, banks did like better than expected, and the market kind of like that. So all banks are going back up this week. So that's a good news, right? So what's a PLC anyway? Well, basically the provision for loss is the expected amount that you think you're going to lose on the credit that you give as a bank. So basically the bank gives a bunch of loans to everybody, so to consumers, to businesses, everybody. And then they look at their loan portfolio and they say, oh, you know what? I do have retailers, I do have hotels or restaurants or oil and gas companies. Some of them will likely default or they're already in arrears a little bit. So let's put them in a special box called provision for loss. It's not money that you lost already, but it's money that you're not likely going to get back. So those are estimates. A lot of people are saying, well, Mike, What about an evil accountant or an evil CEO that would like to manipulate the PLC to make their earnings look a lot better or a lot worse? Well, the thing is, at one point or another, and there's accounting rules for that, you cannot keep a very high provision for loss on those loans forever. So at one point in time, you have to make a decision and either do a write-off, which means you're not going to get your money back, and then you move on with it, and it's a real loss, or you have to decrease your PLC, and which means that will boost earnings later down the road. So in one way or another, you can affect your earnings on a very short-term basis, but over the long run, it won't affect it too much. Keep your eyes on the real stuff, which are the charge-offs. So basically all or also called write-offs. So basically money that has been lost forever, that the company went bankrupt or the consumer just decided not to pay, and that's over. So this is a real loss. Now, we have to look at the entire balance sheet to understand what's happening, because the PLC affect earnings for this quarter, but then it's being added to the past provision for credit loss. So what we have here is the loan portfolio versus the total allowance for credit losses. So basically, those are all the loans in their portfolio where banks think, oh, you know what, I'm never going to see that money back again. So they're very close to a charge-off and then being written down as a real loss. What you can see here is COVID-19, yes, had an impact, but it's not the end of the world. We're talking about, the more confident, or maybe overconfident if you prefer, are BMO and National Bank with less, around 56 to 0.63% of their total loans that should be that are likely to go default. And on the opposite spectrum, you have TD Bank and ScotiaBank, which are the most conservative. So remember the projection, the PLC I just showed you for ScotiaBank increased only of 156. I'm just going to put it over there. So see, ScotiaBank variation was only 156, which is not much, right? But when you look here, it's because they had previously other provision for losses. So now they're pretty much on target along with ScotiaBank, TD Bank, and Royal Bank, which are the largest banks in Canada. So nothing to worry too much here. Like I said, they do have exposure to vulnerable sectors such as retailers, travel and leisures, or oil and gas industry, but it's not the bulk of their loan portfolio. Another way to look at banks is their capitalization. So basically what we use is the CET1. It's basically a ratio that has been introduced after the 2008 crisis. It has become under the rule of Basel III a little bit tighter, a little bit restrictive. So under Basel III, we're requiring banks across the world to maintain a ratio at least of 4.5%. What you see here is, yes, there's an impact. So we all went from like high 11 or to 12% back to low 11%. But still, all banks are showing 11% CET1. So it's not the end of the world. It's a measure of solvency. So it's a good indicator to tell you, you know what? Yes, it was a bad quarter. They can take it, and they will likely be able to take another quarter like this later down the road without being at risk of cutting their dividend or without being at risk of going bankrupt or anything like that. This is obviously if you don't think there will be a second wave of the virus this fall. If we're hit by a second wave and there's another economic lockdown, this video will not age well. Actually, this video will probably tell you something that is completely wrong. Keep in mind that this was one economic lockdown. We're reopening right now, so this is why the market is like all happy and jolly. And yes, we'll have a recession, but if we don't have a second wave, the recession will likely last for about 12 months, and then great company like banks will enjoy very low interest rate debts, so they can borrow to do more projects, and there's plenty of liquidity on the market. So this means that a lot of people will want to invest in the stock market, especially with low interest rate. If you're looking for income, if you're about to retire, it will be very hard to put your money into bonds or into GICs. You will likely focus on dividend paying stocks. And guess what? Canadian banks are offering their best yield ever since 2008. So I think it's a great way to do it. Now, if you would like to have someone to follow your portfolio like this and give you those kind of like review, obviously we're not doing videos, but we do offer a service at the DSR, which is called DSR PRO, where every quarter we look at over 1,000 dividend paying stocks. We measure each company, we look at their earnings, and we see what's happening over there, and we highlight the right place where you should put your attention. If you should make trades, if you buy some, if you should sell some other stocks, we will tell you what's happening so you don't have to waste your time and get overwhelmed by tons of paperwork like we did just to create this video. So if you're curious about it, the link is in the description, or just go directly to dividendstocksrock.com. You'll have the option to register for Pro. If you're already a member at DSR but you're not DSR Pro yet, send us an email. I have a special offer for you. So I hope that you have enjoyed this video. Please subscribe to the YouTube channel to get my notification next time I publish one. Usually 2-3 videos a week is pretty much my average. Hope that you have enjoyed it and that you will invest with more confidence. And until the next video, stay invested.